So tomorrow night, the 24th at 6:30, we have a special webinar with Alicia Barnett. Alicia is my go-to long-term care person. So what does that mean? So she works for the Financial Independence Group, and that's the independent, well, one of the independent insurance organizations that we use. So whenever I have or we have a client with a long-term care need, not if they need care to go into a facility for care or need home care, but how to financially protect themselves. We go to Alicia and her team and say, this is our situation. What's the best answer for it? And she's got a lot of great data. She stays on top of what's going on and what the needs are out there. And of course, what's available to help fill that gap. So that's an important topic. I've been anxiously waiting for this. It's been since I think maybe March since we've had a special webinar, because we've been so darn busy with classes and whatnot. So I'm happy to have the Alicia come back around. And yes, we are still planning an advanced class series by the end of the year. I'm working on finding that on-demand seminar platform. I think I have it, but I want to make sure it's the right one. And we do have a class coming up beginning on the 8th of September. So that'll be a webinar. And you will get an invitation, of course, but that will be Thursday, 3 series, right? 2 hours a night, 8th, 15th, and 22nd of September, or the 13th, 20th, and 27th of September. And of course, if you want to, when you get the email invitation, if you want to share it with your friends or family, it's a webinar, anybody can attend. Up to 500 people, and I think we'll have plenty of room. Today, for our financial planning topic, we're going to talk about advisor and investment fees and expenses. So this is a really good thing for you to review with your advisor, even if it's me, right? We should have this conversation. I always say to new people joining the firm that if we're sitting here a year from now, whether across the camera, across the table, what have you, and you don't feel as though you received tremendous value for what you've paid us, then we shouldn't be doing this anymore. We shouldn't be in business together anymore. That's really the litmus test that I want from my folks. Now, I'll tell you that, I can count on one hand the number of people who have left us since we left Wachovia or Wells Fargo back in 2010. But I do want to make sure that people feel comfortable with the fee that they're paying us. It's very important for you to know what all those fees are, and so that you can determine that value. So I'm going to, and this is a big, I think I thought of this over the weekend. I was reading something, or I don't know what triggered it, but as I was putting it together yesterday and today, the list just kept growing and growing and growing. So our conversation today is going to be just an awareness conversation. We're not going to dig in. I'm going to show you some examples, but it's gotten better as far as fees and certainly transparency, but goodness gracious, there's still a lot to digest out there. And I know when that's a consideration that we make when we're looking at an investment for a client, even a custodian for the client, when we switch from Kestra and NFS to Schwab, we eliminated what are called platform fees, which really saved anywhere between probably 0.15% to 0.3 or 0.5% for clients, which is a huge savings. So, and I'm really happy that we were able to do that. So we're going to talk about advisor fees, investment fees, and expenses. So since we saw each other last time, the Consumer Price Index came out. You all probably heard about it now. It was 8.5% year over year. That's the All Urban Consumers Price Index, CPIU. That's down 9.1% from the month before. Still outrageously high. Market celebrated a little bit, and then market came back a bit yesterday, certainly. But we're going to talk about some of the feelings out there in the analyst reports. We had really two competing ideas between BlackRock and Empower, which used to be Prudential, both groups that I respect greatly. But unsustainable, this 8.5%. So, I don't know what the answer is, but we have to, we've got to battle that. And certainly financial plans, we changed our financial plans to 3.5% inflation going forward. And we did some stress tests at what if it's at 6.5% for the next 3 years. And as I've told you before, we have plans failing. So if it hovers more around 8.5, it's going to be a challenge. So in the Slott updates today, we're going to talk about Roth conversions and 401k to Roth rollovers and some other things. So let me share my screen. Hello, Carol, sorry. All right, so I have to give Kathy credit again. Kathy suggested that I share these notes with you, with Slott notes, so that or the report, what they put out. You can see that this comes in from Ian. This is from the 11th last week, and we're talking here about Roth IRA conversions and Roth 401k to Roth IRA rollovers. So the question is, when converting an IRA to a Roth IRA, do the investments, that is stocks, bonds, exchange traded funds, mutual funds, etc., have to be sold, or can they be transferred directly from the IRA into the new Roth account? So this is a really common question. I hear it wrong all the time, even from financial advisors. They say, well, you can't, if you have XYZ fund or stock in your traditional IRA, you can't just transfer that over to a Roth IRA. You have to liquidate it and then rebuy it in the Roth. That's wrong. That's wrong. So if you're using the same custodian, if you're using Charles Schwab or Vanguard or what have you, you can simply just do what's called a journal. You can take those shares that you want to transfer over and journal them over to the Roth. Of course, you have to pay tax. So if you have to, if you have tax outside of your IRA, it's probably best to pay that tax there if it works in your plan. If you have to pay tax from withholding, then that's where you're going to have a problem, because you can't withhold from a journal, right? So moving those same shares over, you may have to liquidate a portion and then journal over what's best, and then and do a distribution. So it's a little more complex depending on how you're paying the tax, but this is not a tax question. This is really an operations. Can I do this? Can I move XYZ stock or anything that can be held in the other custodian, or the custodian where the Roth IRA is? Can that be done without having to liquidate? And the answer, of course, is yes. There is no requirement that investments be sold before a Roth conversion. If the same custodian will be holding the converted funds, the custodian will simply retitle the existing traditional IRA account as a Roth IRA with the same investment portfolio. If it is a partial conversion, the custodian will transfer the appropriate number of shares from the traditional IRA to the Roth IRA. If a new custodian is used, a conversion can usually be done via direct transfer, also known as a trustee to trustee transfer. So in the investment world, we have something called ACAT. I can't remember what the acronym's for, but it's an electronic transfer. So you can simply, if you wanted to move your traditional IRA from Vanguard to a Roth IRA in Charles Schwab, it's likely that you can do that directly. I say likely because the custodian, Vanguard or Schwab, may not be able to hold the position that is in the account. For instance, Charles Schwab has some index funds that could not be held by Fidelity, who we used to custody before, so we would have to liquidate and transfer that in. So you do run into those bumps, but there's nothing in the rules that say you can't do this. However, if you hold certain unconventional investments, or not even unconventional, just sometimes proprietary investments, it's possible the new custodian won't accept them. So I hope that makes sense. Here's our next question. Hello, can someone age 70 do a rollover to a 20-year-old Roth 401k? Oh, excuse me, do a rollover of a 20-year-old Roth 401k with a former employer to a new Roth IRA without having to start the 5-year clock all over again? That's from Mike. So remember what the 5-year clock is. So the 5-year clock on Roth IRAs, very complicated before 59.5, very, very simple after 59.5. After 59.5, if you've had a Roth IRA more than 5 years, then any contributions, conversions, or growth come out tax-free. If you have had any Roth IRA or haven't had a Roth IRA under 5 years, then your contributions can come out tax-free, your conversions can come out tax-free, but your growth is still subject to tax. So This person asked, well, what if I roll over a 401k that I've had for 21 years? It's a Roth into a Roth IRA. What happens? Does the 5-year clock start? So the answer is it's complicated. Of course it's complicated. We're talking about IRS rules. The 5-year clock on the new Roth IRA does have to start over again, but only for determining whether earnings credited after the IRA or after the rollover can come out tax-free. The period that the funds were held in the 401k does not carry over to that 5-year clock, so it starts fresh on January 1 of the year the new Roth IRA is established. That's why it's important to fund a Roth IRA, even with a small contribution. If you think you might eventually roll if you have a Roth 401k and you might eventually roll into a Roth IRA, open up a Roth IRA with a few $1,000s, whatever you can, and get that thing funded, get that clock started. As early as possible in order to get the Roth IRA clock started. The good news is that the rollover funds themselves, both Roth 401k contributions and earnings credited before the rollover, can be distributed tax-free at any time after the rollover. So there's going to be a bit of an accounting. So if you have $1 million in there and you started at $500,000 in that Roth 401k and it's grown to $1 million, and then you roll it over to a Roth IRA, can you access that whole $1 million tax-free? The answer is yes. If it grows to $1,100,000 within that Roth IRA in the first year, can you also access that additional $100,000 tax-free? The answer is no. So you've got to get through that entire million though before you'll touch that $100,000 because of what's called the ordering rules. So don't worry about it too much. But this is a good question. That's because the Roth 401k owner in this case was at least 59.5. This is why these the distribution will be tax-free. If this person was under 59.5, it's a completely different story. That's because the Roth 401k owner in this case was at least 59.5 at the time of the 401k distribution and held the Roth 401k for at least 5 years. All the former Roth 401k dollars go into the Roth IRA as essentially one big contribution, and Roth IRA contributions are always immediately available tax and penalty free. So that makes sense to me. I hope it makes sense to you. You can see that, again, it's very complex, but it's good to have these resources to go to. Now, how about eligible designated beneficiaries? So we were handed this new level of complexity from the Secure Act. And it's just question after question. Folks, I go through all these questions and I just feel like, yeah, I can't talk about that again. And that's very nuanced. And, but you know, we run into these inherited IRA questions and RMD questions just all the time. I was just talking with a woman yesterday that just inherited some IRA funds from her mother. And I was trying to explain some of the rules, and it's just, I don't know how people do it on their own. It's very, very manifold and lots of questions. So this is from Sarah. You all have met Sarah Brenner. The question here is, my wife, who's 68 years old, inherited a traditional IRA and a Roth IRA from her sister, who was 71 in 2021. Both accounts have been moved to inherited IRAs. I'm trying to do some tax planning. Can you please confirm the following from my confusing research? As an eligible designated beneficiary, my wife can stretch distributions. He asked this as it's oddly asked as a question at the end, but just stay with me here. He kind of says it as a statement and then asks it as a question. So as an eligible designated beneficiary, this person asks, my wife can stretch distributions over her lifetime for both the traditional and Roth IRAs. RMDs are required starting this year from both inherited accounts using the single life expectancy table for inherited IRAs. Remember, you can get that from my website. Yes, he says, thanks very much. So he's checking to make sure that his research is correct. Here's the answer. Yes. Hi, Steve. You are correct. Because your wife was not more than 10 years younger than her sister, she's considered an eligible designated beneficiary. So if she didn't fall in those eligible designated beneficiary rules or in that designation, then none of this, it would be completely different for her. But as an eligible designated beneficiary, she has the ability to stretch distributions from both the traditional and Roth inherited IRAs over her life expectancy. The annual RMDs would be calculated using the single life expectancy table, and the first RMDs would need to be taken this year from each inherited IRA. Now, if she wasn't an eligible designated beneficiary, what would happen? Well, because they'd had to be distributed, the funds would have to be distributed by the end of the 10th year. But going back here, her sister was not yet at RMD age, so there would be no RMDs required during that time. But because this woman is an eligible designated beneficiary, she can use that stretch IRA provision that we all loved prior to the Secure Act that allows her to forget about that 10-year rule and take those distributions over her lifetime. Very valuable, especially in the case of the Roth IRA, of course, right? Because she's 68 years old, you know, she could still have 20 or so more years left in her life, and that's tax-free money, can continue to grow tax-free. So here's the, I think, last question. I have an IRA at Vanguard and one in American funds. This is a great question. Get this all the time. I have an IRA at Vanguard and one in American funds. This person now has to take required minimum distributions. Can I aggregate my RMDs and take it from just one account, even though they're at different companies? Really common question. I've got $500,000 here and $500,000 here. I have to take $40,000 as a distribution. Do I have to take it from both the American funds and the Vanguard, 20,000 and 20,000, or can I just take 40,000 from American and 40,000 from Vanguard? Really, really great question. And the answer is yes, but I'll give you Sarah's answer. Hi, Sonny. We get a lot of questions on when RMDs can be aggregated and taken from one IRA. In your case, there is no problem. You can aggregate your RMDs and take the total amount due from one of your IRAs. The fact that the IRAs are with different companies does not matter. Here's when it does matter. If it is your traditional IRA and an inherited IRA, can't aggregate those. They've got to be taken separately. If it is a traditional IRA and a 401k, you can't aggregate those. They have to be taken separately. People mess that one up all the time. They think, you know, I've got to take, in our example, $20,000 out of my 401k, but I'm just going to take it out of the IRA. They do that for years and years and years. The IRS finally catches them, and now they got to pay penalty 50% of what they should have taken out of that 401k. So, and they've got to take the distributions out of the 401k as well. The other thing is 401ks, if that same question was, I have a 401k at Vanguard and I have a 401k at American funds, can I aggregate them? No, cannot do that. All right, great questions today. Let me stop my share. I do have a question, so let me see what the question is. Walter. Hi, Walter. As part of Roth conversions, when you transfer equities intraday, the market-to-market value is the closing price at the end of the last trading day. So when doing conversions, you can wait and choose strategic opportunities. Yeah, sure. You can be very, so what Walter's saying is you can be, because of intraday pricing and whatnot, you can, depending on what your, mutual funds, if you're doing a mutual fund, they all settle at the end of the day. ETFs and stocks and exchange traded funds and stocks, you can do some pricing. But he's saying you can take advantage of some market fluctuations. That's true, Walter. Most people don't get that detailed about the stock trades within their conversions, because they're usually pretty small. Now, when you're talking about intraday activity, now when you're talking about markets are down 10%, 40%, 15%, wherever we are, does it make sense to do Roth conversions when markets are down? Sure, it does. Is it easier to do direct journals? Take that position and just move it over to Roth? You're darn right it is, because you do have settlement date, settlement time, and things like that. Because if I had to liquidate something in an IRA and then rebuy it in a Roth IRA, honestly, you could have a day or two lag time on that. But good point. Doug asks, can you also aggregate RMDs with a 401k and a traditional IRA? No, you can't do that. No, 401ks and traditional IRAs they have their own rules. And that's the example I just told you. If you have RMDs due in a 401k and an IRA, first, you cannot aggregate them. And people make that mistake all the time, where they think, for example, they can take those RMDs just out of the 401k or just out of the IRA, and it happens for sometimes years, and then the IRS sees that and they say, well, wait a minute, you were supposed to take the RMDs out of the 401k or the IRA, and you didn't. You can't aggregate those. The retirement plans, so 401k is a retirement plan, and IRAs, individual retirement accounts, have some similarities as far as how they're taxed, but their rules are very different. Good question. SEP treated as IRA, Walter asks. Yeah, SEP, well, it depends. Depends on what you're asking, but yeah, it's technically an IRA. Okay, good questions. Okay, moving on. So let's talk about investments. So let's see. The markets were down slightly, depending on what you're looking at. The Dow Jones Industrial Average last week was down. So this is ending Friday, the 19th. Dow Jones Industrial Average was really just about flat, 0.05%. Still down 6% for the year, just over 6%. The S&P 500, top 500 companies, roughly in the U.S., down 1.16%, down over 10% for the year. The NASDAQ is still down over 18% for the year and 2.5% last week. Now, all the what we call the major indices, right? All the different indexes that we follow were down really across the board from what I'm seeing here. The one that is, I say this every week, but the one that is so frustrating and confounding to people is the Barclays Aggregate Bond Index was down also 0.89% last week, down 9.7% for the year, and down 10.53%. It's still hard. I talk to people all the time about this. It's still hard for investors to understand that bonds can lose value because they were taught over and over again, 70-30 portfolio, 60-40 portfolio. As you get older, you put more money into bonds. Very, very volatile time, and probably a much longer glide path to get back to some positive returns for bonds, in my opinion. Interest rates. Let's look at interest rates. We haven't talked about that in a while. The 10-year Treasury closed at the end of the week at 2.97. The week prior to that is 2.83. The year end, it was 1.51. And a year ago, August 19th, 2021, it was 1.24. So I talk a lot about people about real estate. And, there's a feeling that real estate has to soften at some point because of the cost, of course, of funding real estate. And hopefully we see that sometime soon, and not too hard, right? It doesn't soften too much. So BlackRock had a really interesting point. They've been moderating and really shifting. You've heard me talk about they're shifting towards bond holdings. I shouldn't say shifting towards bond. They're changing they have strategic allocation. So strategic allocation is when you have some assumptions, and for a given amount of risk, this is a very simple explanation, but for a given amount of risk, you expect a certain amount of return over a period of time. Then you have tactical allocations. Tactical allocations are, I'm going to overweight or underweight positions depending on what's going on in the economic world. BlackRock does both. We're talking right now about their tactical allocations, and they've been overweighting equity stocks for some time, and they're trimming those back to where they have more bond holdings. So I'm not sure if that's right or not. BlackRock's made some bets in the past that have worked out well for them and haven't worked out well for them. But I'm going to try to summarize this for you. They write, the great moderation is over. The great moderation, a period of steady growth and inflation, is over in our view. Instead, we are in a new regime of heightened macro volatility driven by production constraints. So due to post-COVID supply disruptions and labor shortages in the near term, and structural forces such as bumpy net zero transition. So net zero transition is really about, the push towards net zero energy policies, right? So, and a rewiring of global supply chains amid geopolitical tensions over a longer horizon. So what they're saying is what we've witnessed in the past decade and a half of just this steady growth without much interruption, little bits here and there, is over for all these reasons. We have supply distributions, labor shortages, a big shift in our thought process around the globe about energy. Depending on I'm not sure how you feel about it, but that seems to be the direction. So they say this warrants a higher risk premium, the compensation investors want for holding assets for bonds and stocks. We ultimately expect central banks to live with inflation. This is important. So they're speaking globally here. We're ultimately expecting central banks to live with inflation, but only after stalling growth. The result, persistent inflation amid sharp and short swings in economic activity. There is great uncertainty around how the conundrum facing policymakers gets resolved. Central banks have turned increasingly hawkish, which means they want to raise interest rates to counter elevated inflation, sparking a sharp repricing higher of expected policy rate. That's a lot of rhetoric there, or a lot of industry jargon. So I'm trying to make this a little simpler. So they're saying that discussion is intensified since the last update is so last week, since the last update is policymakers, or perhaps last month, continue to respond to the politics of inflation. We no longer expect central banks to pause at neutral, the level of rates that is neither restrictive or stimulative, even though tighter policy does little to address supply-driven inflation. So they're saying they really don't expect central banks around the country, around the world, to back off of this rising interest rate push. It does mean growth over the near term suffers, and interest rate sensitive sectors of the economy bear the brunt, like the bond positions that we're talking about. In our capital market assumptions, we further raise our estimates for the policy path across major central banks that feed directly. Okay, that's so they talk about trimming their stock overweight for. I talked about that for bonds. Let me see what else is. Okay, so BlackRock, one of the largest investment firms in the world, and I do greatly appreciate their research and respect their research. So what basically they're saying is they expect the central banks to keep rising interest rates, and that we're going to be seeing persistent inflation. They don't really put a level on it, but persistent inflation, for some time. Now, let me read you kind of a counter position. So this is from Prudential, now called Empower. Robert D. Lucia, again, greatly respect his work. He writes, as I've repeatedly noted, the future path of inflation is a critical variable outlook for the financial markets. So we talked about the announcement of the CPI last week. The equity markets rallied strongly on the news with gains of 4% in the S&P 500 and NASDAQ in just 3 trading days. They talked about the Russell 2000 jumping. As you know, we've given some of that back as of yesterday. Markets are up a little bit today. Let's see. And he says, here is some data suggesting that the trend in inflation is likely to be lower over the next 12 months, with favorable implications for monetary policy, the economy, and market prices of risk assets. So here are some of the other indicators that he's talking about. So he ended this discussion about so much of the consumer price index is based on real estate, rents, things like that. And he said there's some other things that are suggesting that the inflation has peaked and could be in a sustained downtrend. The producer price index, so that's the cost of making goods, for July fell by 2%. Commodity prices have declined by 20% from the March 2022 peak. Global supply chains are gradually improving. Delivery times among manufacturers have shortened in recent months. Purchasing managers are reporting a sharp slowdown in input prices. Labor costs are showing some preliminary signs of easing. Pulling it all together, he says, investors can safely conclude that inflation is at an inflection point. My forecast, he says, not my forecast, my forecast assumes that inflation will trend lower over the next 12 months, led by declines in prices of consumer goods, compared with monthly increases of 0.55% during the first half. So let me fast forward that. Going to the end, he says, during the second half of the year, the core inflation, he says, during the second half of the year should be around 4.5%. 4.5% is still unsustainable from a financial planning point of view for the long term for many, many folks. So even if De Lucia is right, and he's obviously very optimistic in this, it could really have a great impact on many folks' financial plans. So, how do you handle all of that? We talked about, these investments that investment returns that are kind of all over the place, right? They're negative, they're positive, it's going to be a very, very volatile market. Probably you've heard me say for the next year and a half, 3, maybe 5 years. I hope it's not longer, but you've got to first have your plan, understand your plan, know where your cash flow is coming from, and use the tools of asset allocation, principal protection, and account segmentation. If you can include guaranteed income in there, I mean, that's all the better. But there are ways to hedge this. We've been very, very fortunate. We made some moves earlier in the year to liquidate bond positions. I was very concerned about fixed income, and we're holding a lot of cash, and we just kind of paused while everything was going on. Now we're starting to implement strategies again, as you've heard me say, but that pause was very beneficial to our clients, and I'm thankful for it. I'm not saying I'm any kind of investment genius here. I just, it was just very, it was a good opportunity and very fortunate, very lucky. So you want to be defensively optimistic, understand your plan, understand your cash flow, and take advantage of asset allocation, principal protection, and account segmentation. All right, moving on to financial planning. I'm going to share my screen here. And this is a long topic, so we're going to get through this as quickly as possible. So I'm hoping you're seeing something that says financial planning topic, advisor, and investment fees. Raise your hand, click your raise your hand button if that's what you're seeing. Thank you. So if you're joining us now just in this topic and you're seeing now financial planning section of this discussion, first of all, you can always go back and look at the full webinar, weekly webinar. You can sign up for our weekly webinars on our website. And there's a link in the description in the YouTube description, and you should also subscribe and like and hit the notification bell so that you stay on top of the YouTube videos because we do a new financial planning topic nearly every week. I don't miss many. So this week we're going to be talking about advisor and investment fees, and I'm going to just share with you that I just started plotting this out, and there's just a lot here. So let's talk about some of the questions you should ask. Some of the questions you could ask someone like myself or someone that you're considering working with. What are all of the fees? What are all the advisor fees? So we have a really simple platform here. Let me just find my fee schedule. It's here somewhere. Let's see. I'll just blow this up if I can. Why isn't that getting bigger? Okay, so you can see that this is the updated fee chart here. Let me just close this. So, we started $1 million. Typically, we don't work with clients under $1 million. We have resources for that, but from $1 million to $2 million, you can see here, this is the assets under management. We use primarily the assets under management fee structure. So for most people, they transfer their accounts to us. We handle all the investments and transactions, and they pay us a fee for that. And that includes comprehensive financial planning and tax efficient planning. So these are our tiers. I don't want to go into what we're doing much. I just want to talk about what you should be asking. But $1 million to $2 million at 1%, $2 million to $3 million at 0.85, 3 to 4 at 0.75, 4 to 5 at 0.65, and anything above usually lands around 0.55%. It depends on the structure and the planning and everything else involved. And then we'll also entertain just flat financial planning. And sometimes we just help folks. So we'll charge somebody a flat fee just for financial planning. If someone says we want to handle everything ourselves, we just want you to do the plan, and we'll handle the implementation, and then the implementation's on the client. And then some people say, I have my plan, I want to implement it myself, but I can't find something that is principal protected that fits into my plan. I need help finding the proper life insurance policy, and we can help with that. But most people, 90 plus, probably 99% of the people hire us all in comprehensive asset management, or comprehensive financial planning and investment management. But you should be asking, what are all the fees, right? So I just showed you, that's really simple. And then if we do break it down where we just have, if someone comes in and they have, they say, we want you to just handle the investments, well, we don't just do that, but we'll, if they're below $1 million, we'll help them with the investment and we'll charge a financial planning fee. And we have 2 separate agreements because I want clients to know exactly what they're paying for each portion of the services. So what are all those fees? The average in the industry is probably somewhere between 1 to 1.5%. But honestly, most companies are only giving you investment management for that. So you've got to ask them, well, what am I getting? Am I getting, if I pay you 1% or 1.5% to manage my accounts or manage my retirement, help me put all this together, what am I getting? So what do you get for these fees? And most people, again, they'll charge you 1 to 1.5% for just investment management. You should be asking, does that include tax planning? Does that, or financial planning? Does it include tax planning? Does it include tax preparation? I get that question often. We don't do tax prep. We do a lot of tax planning. We have great resources for tax preparation, but that is not something that we include in our fee. So clients pay, probably anywhere from $500 to $2,000 a year in addition for their CPA. I believe you should be working with a CPA to be doing their tax preparation, depending on how detailed it is. It could be, obviously more than that. Financial planning, listen, our minimum financial planning fee is $5,000. It could range anywhere to $25,000. So you've got to understand these fees. Again, if clients are working with us with comprehensive and they're over $1 million the comprehensive agreement, all of these things, right, are included in the 1% or whatever their fee structure is, but that's not true with everyone. So you've got to ask these questions, what's included? And we're going to talk more about investment management, financial planning, tax prep. And so the reason you need all this information, because what if you have $1 million, right? And you're paying 1%. Well, we know that's $10,000 a year. At the end of the year, you should be determining, well, what's the value of this versus the cost of it? And again, I always had this discussion with new clients. I want you to, if you're not receiving tremendous value or the fees that you pay us, we shouldn't be doing business anymore. And it never comes up again. We always share our fees. We send out, billing reports. It's in the performance reports. Our performance reports show net of fees. But that makes me feel good because clients always ask about it in the beginning, and you should, but it never comes up again on their end. We remind them, of course, what they are. But you've got to be able to determine that value versus cost, because I had a person one time and she had about $1 million that came to me after a class, and she was with another firm. And she said, I was talking about fees. So she's talking about her advisor and the work he does for her. And I said, what does he charge? And she said, he charged me a $500 annual financial planning fee, and that's it. And I said, that's really, really unusual. And she said, he's very courteous about it. In fact, he just contacted me and said, is it okay if I take my fee this month? And I said, that's it? That's all you pay him? And she said, yeah. So I started going through her statements, and sure enough, there was another fee, right? So she had $1 million, and there was a 1.5% asset management fee. So she wasn't paying $500. She was paying $15,500. Now, forget about disclosure for a second, right? That's inappropriate, I believe. And maybe he did disclose it to her and she didn't understand, but she should understand that she's paying $15,500 a year, because then she can evaluate the value. She might say, well, geez, I appreciate the financial planning he does. I appreciate the comfort it brings, knowing that I have somebody available there, because it's not all technical stuff, right? We work very hard on the technical side to make sure everything's right and we're getting the best value all around for you and the best investment returns and protections that we can. But there's also just that comfort knowing that somebody's looking out for you, right? There's a lot of value to that. He might be doing tax planning, but she had no idea. She just thought that she had like the sale price of the decade of somebody working to help her manage her retirement plans. And by the way, she did a financial, she showed me a financial plan. It really wasn't a financial plan. I'll have to do a whole other discussion about that. Most financial plans are just what we call an asset gathering tool. That's how it's taught at the big firms, but it really wasn't a financial plan. So, but she thought she had this great big value of financial planning, investment management, retirement planning at $500 a year, but that really wasn't truly the cost. So she had no way of evaluating that value versus cost. So then that's just the advisor fees. Now you got to get into the investment fees and costs. So this is where the list gets kind of long. So the most common type of investment are mutual funds. So here's what I did. And we're going to go a little longer. Just stay with me if you can. So I went in, hopefully this stays. You should see, this is a research page, really simple research page from my custodian, Charles Schwab, one of my custodians, Charles Schwab. So you'll see these are some common funds. So just raise your hand if you see that, the Charles Schwab page, and there's just a list of mutual funds there. Thank you. This is none of these are recommendations, right? These are examples. They're not recommendations, but this is what you have to pay attention to. These are the questions you should be asking your advisor. What are your fees? What are investment fees? Because I want you to just take a look at the this first one, for example, right? This isn't highlighting well, but this American Century fund. Now, again, this is not it's not in our, we don't use this fund, but I'm not saying you shouldn't. I'm not saying you should. This happens to be an A share class fund. That means it has a front end load. I'm over here, right here, if you can see me. Let me grab my pointer. All right, I'm over here. So it's got this front end load, 5.75%. So there's breakpoints in there. You can pay anywhere from 5.75% to purchase it all the way down to, probably 1%. And this still goes on. There's been a lot of changes with fee structures, but this still goes on. I just had a new client who has some A share mutual funds. And I said, well, listen, you just paid 5.75% to purchase these funds. I kind of want to let you leave it where it is for a while. We'll keep an eye on it for you, but I don't want you to get out of that and then have to pay an ongoing fee. We charge, we don't charge an upfront fee. So it doesn't make sense because, then the internal expenses are right here. So you got the 5.75% and then the fund call, make it more confusing. The gross expense ratio is 1.5%, but the net expense ratio, sometimes mutual funds give fees back, make it more confusing, right? Is 1.8%. And then they have these 12B1 fees, which are ongoing commissions to the custodian or the broker, right? So I'm just showing you how confusing this could be. Now that's an A share class fund. Here's a institution, this I share class fund. I'm 3 down here, MFS, for example, again, not a recommendation. You'll see that they have a gross expense ratio of 1.5% and a net expense ratio. Let me explain expense ratio on a fund. Expense ratio is what it should totally cost to operate that fund. There are potentially some additional other small charges beyond that, but this fund, for example, would cost you just about 1% to own that fund. There are no additional 12B1 fees. And it really ranges here. You'll see, so here's some ones. 1 is very common. You go down here, you see 0.7. I can sort this. Let's see. Yeah, forget that. This isn't accurate. 78.92% expense ratio. It may be stated, but there's certainly some givebacks on that. So here's an expense ratio, a gross expense ratio of 5.6%, and then a net of 1.89. And yeah, here's an example. So even if their gross is, that's got to be an error, but their net expense ratio is 1.3. Let's just search it here. Let's see the highest net expense ratio. Yeah, 7.62%, 3.67, 3.43. You can see where these can get really expensive. And now if I search it this way, you'll see, hopefully We go on the lower end. Yeah. So if we go on the lower end here, and you shouldn't just buy it based on the expense either. This is the value versus cost question. And that's another question you should be asking your financial advisor. If the financial advisor says, well, I want to use the fund that costs 5% a year, there better be a really good reason for that. You'll see some of them are as low as 0.10, 0.14. So you can get some low cost funds, but that doesn't mean quality. So I share this with you because, as I said, it can get a little confusing. Now, and this is why you should ask your expert the question, and he or she should be really, really open about sharing that. Now, let's look at it before I move on to the Fidelity Freedom Fund. Let's look at an ETF. So an ETF, an exchange traded fund. This is a really common fund, exchange traded fund. This is a Vanguard S&P 500 fund. Exchange traded funds trade differently than a mutual fund. I like exchange traded funds because of their low cost and their efficiencies, but again, not a recommendation to purchase it. But you can see here, the expenses of owning this exchange traded fund are 0.03% compared to probably on average somewhere between 0.7 to 1%. So the mutual fund and just give you some insight, when you're talking to your advisor about the cost of the funds, if I have a mutual fund in a portfolio that's got an expense ratio of 0.7% or 1%, I'm going to have a very good reason for having that in there. And it's either that they perform well during down markets, or perform well during up markets, and they can't be beat by something as passive. This is a passive investment, the S&P 500 Vanguard fund, because you don't get any sophisticated or manager input at 0.03%. Hope that makes sense. Again, I know it's confusing. Let's look at the Fidelity Freedom Fund as another example. So these target date funds are really, really popular. This is right from Google Finance. So while you could probably go into Schwab research actually, but you can see here, I just Googled this and pulled it up, and the expense ratio is right here on the right, 0.75%. So these are relative, I would say that's a relatively expensive fund in the scheme of things, but this is very, very popular. People buy these in their IRAs, they buy them in their 401ks all the time, and they often don't know the expenses. And by the way, ask your 401k provider what the expenses of your investments are, because that's important. All right, just one more. Let's see. I have I think we already looked at this. Yeah, the Vanguard 500 index, and this did not have on here the expense ratio, and that's why I took you to Schwab. All right, so lots of questions to ask about the costs of investments. We talked about mutual funds, we talked about ETFs, exchange traded funds, and you saw the difference there. Now, what about individual stocks and bonds? Well, typically there's no cost to owning an individual stock. That's where the portfolio manager, if your advisor is working as a portfolio manager to put together individual stock and bond portfolios, that's where you may pay a little extra and above the 1%, or maybe that's part of the 1% fee that they charge you to put together that portfolio. So a good answer would be, well, I charge you 1% and that doesn't include finance. This is not me, but someone might say, I charge you 1% and that, while that doesn't include financial planning, it includes a customized portfolio strategy that we put together that includes individual stocks and bonds. And this is why I believe that's a better approach. So again, you have to see if that's a value for you. I don't put together individual investment, individual stock and bond portfolios for my client, because I don't believe that a financial advisor like me, who's meeting with clients all the time, can really dedicate the time that's needed to manage a portfolio like that. So I'll use investment managers, I'll use exchange traded funds, but there are plenty of people with, my focus is on the planning. There are plenty of people whose focus is on the investment side, the investment individual bonds and stock side of it. Again, I think we're very good at finding the great managers to fit in there. Some people want to manage it themselves. And then the investment managers, the managers that we want to bring into the portfolio, we have to evaluate the fees, and you should ask what those fees are. If I say to you, I want to bring in Vanguard, as an investment manager, you've got to understand those fees, or at least you should ask what those fees are, because again, you should be able to value or check in on the value of the cost versus the value. Then you have custodian fees. So this is something we moved away from, thankfully, from our Fidelity relationship, but it used to be every year there were IRA fees, and then there became statement fees and all these fees that Fidelity charged. Well, our new custodian doesn't have those fees. I'm thankful about that, but there are some trading fees. So every now and then we'll have a mutual fund that will get charged, $5 or $20 to trade within Schwab. So all these things add up, and you should know generally, or you should be asking the question, and your advisor should be able to quantify the value of the fees that he or she charges, and that's built into the investment process. All right, folks. So we're a little over. We're almost at 11 o'clock. I hope that was helpful. Looking forward to seeing you tomorrow night for our special webinar with Alicia, talking about long-term care planning, and next Tuesday again on our weekly webinar. Thank you. Have a great day.